Welcome to the Investing in Real Estate podcast. I'm Clayton Morris.
I'm Natalie Morris.
And this is the show where we talk about cash flow, creating passive income. And the vehicle that we use is real estate investing. We are longtime rehabbers, flippers, and buy and hold investors. We run the company Morris Invest, which is a turnkey real estate company. And we've helped hundreds of investors buy their first property. And we've rehabbed thousands of homes. And we had a very busy weekend. Just rehabbing a number of homes now that's getting nice and warm outside. We can actually get our guys back up doing siding and doing gutters and getting pressure washing done because it was been like 60 degrees, but now it's plummeting back down to like 4 degrees again. So you can't cut siding when it's like 4 degrees outside.
Right. What is your thing about March? It's like a lion and a lamb?
Like a lion, out like a lamb.
Okay.
Because you're from the West Coast. Well, I'm on the East Coast. You know, you get tons of like nasty weather in March. And the thing that's deceptive about February, you feel like you kind of get through February, you're kind of on your way, right? You're on your way to spring.
Yeah.
But then all of a sudden March comes in. It's like a bitch slap.
Usually you give me dirty looks when I say words.
Well,
like that.
I think people who understand and who are on the East Coast or, in the North or whatever, in Midwest, you understand what March is like. It's miserable. Ooh. Yeah, that's why the St. Patrick's Day is in there. Right. Because you need to break it up with some hot toddies and some drinks.
I don't think people drink hot toddies on St. Patrick's Day.
Well, they drink something. They drink a lot because they're like so mad at March.
You're showing your coolness now. Uh-huh. No one drinks hot toddies on St. Patrick's Day.
All right, they're drinking Guinness. And then they start off the day drinking a hot toddy.
Okay.
All right. So
today we're going to talk about credit, whether you should buy your investment properties on credit, if you should do that and your circumstance warrants that, how should you do it? How should you evaluate how to do it? Now, we do have an episode about evaluating debt, and we've talked about that several times, but it doesn't hurt to sort of go over the main principles of debt because this is something you should be repeating to yourself anyway. Maybe you think you got it, but for us, like I totally understand the idea of good dad, bad dad, rich dad, poor dad, hop on pop. What was I saying?
You understand the difference between good debt and bad debt.
I do, but there's always a reason for me to go back and evaluate some kind of financial product. Like things cross my desk all the time. Should we do this? Should we do this? Should we do this? And I have to think, okay, is this good debt? Are we paying too much money for money? Are we switching out one good banking product for another one? And so these are things that I use all the time. So it's good to just do a refresher course.
Right. So, we'll dive into this. You sent in a bunch of questions, and our good team has collated a couple of questions around debt. We're actually going to be doing, we started doing a number of YouTube live streams lately as well, where we can answer a lot of live questions.
We'll do it live.
It's been a big success, and we've had many of you jumping on our live streams on our YouTube channel. So you subscribe to the Morris Invest YouTube channel. We've got tons of videos over there, but we'll spend like an hour. Natalie and I will be live. We're going to try to do it once a month, and it's been a lot of fun to do that, so we can answer some of these questions live.
To play us out. Okay.
That's a little Bill O'Reillyism. Okay, let's start. First question.
Okay, so the first question we have that we'll be, again, addressing on the live stream, but we'll address it on the podcast too, just in case you can't get enough of us, which, of course, why wouldn't you? How do you get started without using credit?
How do you get started without using credit? Well, of course, if you've got cash. So that's the most obvious way. I'm going to handle the dumb questions here. So, me being dumb. If you've got cash, then you don't need to use credit. And I like to think of free and clear properties. I remember years ago listening to a podcast with my buddy Joe McCall, Alex Youngblood, and somebody else. And I've since become friends with them, and they're great high-level real estate investors, millionaire real estate investors. And I remember them saying, and it just stuck with me, free and clear is the promised land. That was what they were talking about. And I remember I just stuck that in the back of my head, and I thought, I own a bunch of rental properties already, the ones I have in Michigan. And this was when I was young. And I said, yeah, they perform great for me. I don't have any repairs. I don't have to really worry about them. I've got great long-term tenants in the properties, and they're free and clear. And if they're vacant for 3 weeks or a month or 2 months, big deal. Because I don't have any debt on those properties.
Right.
Because I paid cash for them. So the number one way to do it is to pay cash. free and clear is the way to go. What would you say is another alternative?
Well, another alternative is to think creatively about how to partner up with deals, partner with other investors. You can sort of structure notes with people you know who have some cash, who are interested in a good investment, but don't want to manage that investment. You can, a really great way is to go to local real estate meetings. My sister just moved to a new market and she wants to really start to invest in that market. And she didn't know anybody and she had done some market research. So you know what she did? She went to meetup.com and found real estate meetings, which they call RIA meetings. And bless her heart, she has gone to every stinking meeting in the last month, and she's met tons of people who want to buy, flip, hold, wholesale. And so when she comes across a deal, she can either find other investors who have cash to help her close quickly on that property so she can work on it and flip it. Or now she's got a Rolodex of a ton of like-minded people who can help her. So there's always people willing to help you. You just have to expand your horizons. It's not just you and your dad, right?
Right. Well, and another thing is, and to be fair, your sister went through, my mentor is Tom Kroll, probably the best wholesaling coach in the country. Your sister went through his course. Now, she has an enormous leg up on local other investors because she's gone through his wholesaling course. Now, she's going to be able to turn, I think she's going to be able to turn like a minimal investment of going through his coaching into tens of thousands of dollars. That's how I started, was using wholesaling as a means of getting funds in place in order to buy my first few rentals, having that cash on hand. So, by the way, if you're interested in going through Tom's mentoring, there is no better coach, hands down, in the country than Tom. And we have a link on our website because I stand by it. I absolutely wholeheartedly believe he's the best. Just go to morrisinvest.com/wholesaling. And that'll take you to a sign-up form. You can book a call with Tom's team to see if it's a fit with you, because it's not a fit for everybody. But I will tell you, like your sister, being able to have that cash on hand because of wholesaling, $10, $20, $30, $40, $50, $60, $70,000 from a few wholesale deals can get you to your first 2 rental properties free and clear.
Now, my sister and her husband, they just moved to this new area. They don't have regular jobs there yet, so they decided we really want to get started in real estate investing. They don't have cash to buy these properties, but because they have made it their mission and sort of put it out into their universe, we are investors in this area. Then she found a really great deal last week. She was able to turn it over to someone who was also an investor who could help her close on that, just because she'd been meeting people, finding like-minded people. So there was no cash out of her pocket involved in that deal. She found it herself by, pounding the pavement. But she was able, so there are plenty of ways to find cash. You just have to really expand your horizons.
And she made $5,000 off of that deal. And that's her first wholesaling deal. I mean, that's great. My first wholesale deal was $2,300 or something like that. My second one was $43,000. So that $43,000 I made off my second wholesale deal without having to come out of pocket at all.
That was exciting.
I was able to buy another rental property.
We were very excited.
Very excited. All right. What's the next question?
Okay. Is there a difference between personal debt, like credit cards and car loans, and business debt to refinance rental property?
Well,
survey says... Yes.
Yes. Yeah.
Survey said yes.
Well, you want to tackle this?
Well, yeah. So, I mean, obviously, even within your personal debt, there's going to be good and bad debt, right? Because your personal debt, you can have acceptable debt, like your home loan or your car loan, or depending on the size of that car loan and depending on your cash stream from your day job, right? But then there's going to be some bad debt, like designer clothes on a credit card, right? So that's probably the worst use of debt, right? Can you think of anything worse than that?
Like a boat?
You always use this boat example. Well, because what if people need boats? Like,
how many fishermen? How many fishermen do we have in our audience that need a boat?
There may be. They're enterprising people.
Okay.
So
I'm saying a recreational speedboat. All right.
Okay.
Like you're going to go water skiing.
Or maybe your goal is to become a professional water skier. Let's not diss the boats. But yes, okay. If you buy a boat,
well then let's not diss designer clothing, because maybe I want to be a runway model. You bring up designer clothing. I need that. I'm going to become a runway model.
All right. You can make an argument for everything, but in your life what's wasteful spending and what's not. Right.
Right. Well, for instance, okay, we just had the folks from Fund and Grow on the show recently, right? Where you're able to get business lines of credit. And by the way, if you're interested in booking a call with those guys, they're phenomenal. And we've had a lot of our listeners have been able to get, tens of thousands of dollars in credit from them, which is amazing. So you can book a call with them through, again, we have all the resources up on our website to help you. It's just morrisinvest.com/funding. Anyway, those are business credit cards. So I think when we signed up with them, we got like 4 cards, and I think they each were like in that 15 to 20,000 range. So imagine that. That's a rental property right there, thanks to them setting up business lines of credit. Now, it's not tied to your personal credit. So it's not something that if for some reason you didn't pay it, it would affect your personal credit score. But setting it up used your personal credit. So, and then you're having that debt. So let's say you've got $30,000, $40,000 outstanding on one of these cards from a rental property. And then, of course, you're refinancing it into a longer-term loan. Is that that's not considered bad debt, is it? Especially if the interest rate is 0. Because most of these cards are like 0% to start.
So you want to see a credit card as a banking product, not as like a separate thing, right? So you have to think about every time you're offered money as a separate product. A refinance on your home is a brand new banking product. You're going to pay for that as if you went to the store and bought something, right? You're going to pay a closing cost. You're going to pay some servicing fees. You're going to pay some interest, right? Credit card, same thing. Sometimes you pay a yearly fee. That's the price of getting that thing. Sometimes you pay some kind of interest rate, right? So you're going to evaluate it like you would any other banking product. What is the closing cost? Sometimes it's not uncommon for a credit card to have $50, $60, maybe $100 yearly fee. I've never heard of much more than that. Have you?
Oh, yeah. I think I actually had one that was like a $300
yearly fee.
Yearly fee. I think it was that one.
Your credit must have been dumpy.
Remember, I went through a foreclosure. Yes, my credit was terrible.
Yeah, no, I've never, a lot of times that's based on your financial fitness, or maybe you have one that's like really super high rewards, but I don't think it's very common to have more than like $150.
Yeah, no, I think you're right, or $99.
But again, think of that as the price of the product, as if you went to the store and got something, right? So then you think of what the interest rate is. The interest rate, the same on your mortgage, the same on your refinance, the same on your car. It's just a banking product. So you think of these credit cards as the same thing. So if you go and you buy something on these credit cards, does it compare to what you could get at a bank? Does it compare to what you could get from an investor? Does it compare to what you can get if you refinanced another property in order to leverage that and buy a new one? You just evaluate it the same way. So if you were to get one of these Fund and Grow products or any other credit products that allows you to invest in real estate, just think of it the same way. 0% interest for a certain amount of time, awesome. 17% interest on your personal credit card, not awesome, right? So you just have to think about the terms.
Right. It's always good when a lot of people will ask about refinancing. Like, oh, I think I'm going to refinance my primary house because I think the rates are so good. The problem is that people get lured in by these refinancing programs for their primary residence because they think, oh, the rate is a little bit lower. But when you add up the closing costs and all of that to redo this loan, it's very deceptive, and it may end up costing you. I think we actually did this and made this mistake years ago on our vacation home. When we did that, we refinanced it into a 15-year note from a 30-year note. But did it make sense for us? Because there was like some hidden cost. Not a hidden cost. It's there written down on the HUD. You get the info. But we ended up paying a boatload for that, right? We did.
So here's what they taught us in real estate school is if you intend to stay in the property for a certain amount of years and you can recover the cost of the product, right? The closing costs within a certain amount of time that you're going to stay there, then you should do it. So for instance, say you refinance into a lower rate and that takes your payments from $1,200 to $1,000, right? So your new mortgage is $1,000, but the closing costs are $5,000. So what's $5,000 divided by the $2,000 savings? So are you going to stay in the house long enough to recover the $5,000 of closing costs? If the answer is yes, then you're going to save money. If the answer is no, you're only going to be paying up into saving that amount of money. So we didn't know we were going to have another baby. We paid, that too. We didn't know we were going to have another baby, which meant we wanted to buy a bigger house, so we moved. So we refinanced that house and paid a lot of money for the closing on that new banking product. And then we ended up moving like a year later. So we did not recover the money that we had put into that product.
Right. So just be aware of that, the allure of that slightly lower interest rate, whatever it is that's luring you into that refinance, whether it's going from a 30-year note to a 15-year note and you think you can get better terms. Look at the total amount of that closing cost that you're going to end up paying. It's a lot different on your primary, like for instance, on the houses that we do, like with our company at Morris Invest, like our closing costs end up being like $300-$400, something like that for closing costs. But for our primary, it was like, how much was the closing cost? It was like thousands, right?
It was like $12,000.
It was like $12,000 for closing costs. So it's a lot different than when you're doing like, affordable investment rental properties than it is on a $500,000-$400,000 home. So just be aware of those costs before you dive into it.
Now, along the same lines, we have another question about a way to properly classify your debt, like good or bad. And this person puts a qualifier. They say, the aim here would be to speak particularly to those in the audience who have a no debt under any circumstances, cash only background. Now, that's really hard to do, to only ever use your debt. I mean, if you think about structuring a deal with an investor partner, you still are going to have debt to that person. I mean, I don't just walk around the street and someone says, "Hi, Natalie, here's $40,000 for you. Pay me back whenever," or don't.
Well, unless it's like a parent, a grandparent, or somebody like that.
Even then, like you, I don't know, you pay your, in my family, we do put interest on the...
Yeah, but trust me, I've talked to some investors who've worked with us who, say, hey, my dad wants to be involved in real estate. He's gonna spring me $50,000 for my first rental.
With no debt? With
zero interest. No, that's rare, but that's, family, right? So
I wouldn't do that.
That's, well, I know. I wouldn't either.
My parents did not do that for me. My mom lent me $100,000 for my condo in San Francisco. And when we closed, I paid her back with interest, and she set the terms on that. And of course, it was low.
But wait, I'm sorry. What was his question again? Like, because I'm saying, yes, there are people that do that. There are grandparents out there that will lend to their kids or just to get them started, You're
right. We're on a tangent. Okay. The question was, is there a way to properly classify good or bad debt? And again, we're talking about what kind of debt. What are you using it for? Are you buying Clayton's...
comic book collection?
Clayton's boat.
My boat, yeah.
His, maybe we'll think of the boat that you see on that Lifestyles of the Rich and Famous.
Like a yacht?
Type boat.
Yeah, like a Mariah Carey yacht.
Yeah, like a Robin Leach kind of boat. So that we'll call our bad debt, right? You don't need that if you already have a place to live. So that kind of stuff, like luxurious non-necessities type spending on high interest banking products. But good debt is you consider something that you're leveraging, right? Something that you're paying into. So an investment property, if you've done your homework and you know that it's going to pay you back a specific rate of return, is good debt, right?
Right. That's good debt. Yeah, I mean,
good stuff.
All right, what's the next question?
Do I need to get out of debt before I start investing? And I get this question a lot on my personal blog as well. People say, well, should I pay down debt or should I start investing? And I know we've talked about this before, but again, I want to encourage you to just evaluate what you're paying for the money that you've already spent. Do you have high interest credit cards? And evaluate what you can make from the money that you can invest. And again, just place them, like I said, on a scale or a teeter-totter. Which one's heavier? If you're paying a ton of money and you're going to continue to pay a ton of money for the money you've already spent, knock that out as fast as you can. But if you have some good debt that's like, I'm going to say 5% and below, and you think think your investment can make 8% and above, then obviously you're going to do better putting your money in the investment than paying down that debt. So can you split it up and funnel more money into your investment?
Like we've used our home equity line of credit strategy to both pay off our mortgage and buy rental properties. So buying a couple of rental properties and paying off simultaneously, not just doing one or the other, but doing them in tandem. But you really need to be good with your numbers. Open up a bottle of wine, sit down and figure out with your calculator what exactly you're going to do and really map it out. You can't just guess at this. You need to run the numbers, get a spreadsheet, and really figure out where you're going to be with this strategy.
All right, last question. These two go together. How do you find capital, and what do you put in your private money presentation, like how you build relationships and confidence? So we've already talked about looking out for people in your life who can help you with your investment goals and going to other places with like-minded investors. But what about what you put in the presentation? Say you've got a close group of friends and they've got some money and you think, oh, well, I can show you what it is I'm doing, and you can tell me if you want to get involved in that.
So I've built a whole private money series on my YouTube channel, on the Morris Invest YouTube channel, which is I think a 4 or 5 video series, and it's called Private Money. And in that, I walk you through exactly what you should have in your private money presentation. Word for word, I break down exactly what you should put in your one sheet, and that is a presentation that you're going to take to a local real estate meeting over coffee. You're going to go on LinkedIn and do a search for private money investors in your area, and you're going to take them out to lunch, and you're going to show them exactly what types of properties you buy. So, for instance, I know exactly what properties I buy. My favorite properties are C-class, B-class properties, in the Midwest. They're going to be in that $40,000, $50,000 range, 3-bedroom, 1-bath, 2-bedroom, 1-bath. They're going to cost, like I said, $40,000, $50,000. They're going to cash flow between $650 a month to $800 a month. And that's what I'm going to present to them. These are the houses I buy. I've got, we got 75 properties that we currently own. I want to buy another 25. That's exactly what I want. Here's what I need the funding for. Your return on this investment will be this. And that's really what you want to have in there. A little bit of biography about yourself and your family.
It's
where
like your
you buy.
investing resume.
Exactly. And you want to be professional about it, but you need to be specific, because if you meet with a private investor and you're like, oh, I think I want to get involved in real estate, what they'll say to you is, great, when you get your stuff together and you figure it out where you're going to buy properties, where you're going to be and what you're going to do, then come talk to me. I don't have time to waste on you if you don't even know what you're going to buy. So, we know exactly what we buy. We try to buy a couple properties per month when we can, when we've got the capital to do it. Whether it's our 401k, whether it's our HELOC, whether it's our fund and grow money, whatever it happens to be, we use that to go and buy more properties.
We do that.
So that's some good questions. If you have any other questions, please email them into us, or you can always go on our Facebook page. We also have our YouTube live stream. We're going to be doing once a month. You can go over to our YouTube channel, Morris Invest, where we try to answer a lot of these questions. We'll spend about an hour. We'll try to spend as much time as we can until the baby starts crying. And try
which is
now. Yeah, we just heard the baby crying, and we got circular saws here at the job site. So that's it, right?
That's it. Thanks for listening, everybody. We'll talk to you again soon here on the Ye Old Podcast.
Ye Old Podcast. And if you are ready to take action and pick up your first rental property, and you want guidance on how to do it, that's what our team does at Morris Invest. It's a simple 3-step process. You book a call with us. That's the simple part, right? You answer a few questions and you book a call with us on the calendar that suits you. Then we'll jump on the phone with you and talk to you for like 30 minutes. We want to find out what your freedom number is. We want to find out how many properties, what your financial freedom goals are in order to create passive income and reach financial freedom. That is, of course, very important to us. Are you at 12 properties? Do you need to hit 15 properties? And what is your current financial situation? We'll map all that out for you. And then, of course, third and finally is that we'll take care of the rest of it. We match you up with a great property, and then we do the rest. So that means we do the full rehab, and we get it fully rented. That's what we do. And we have many hundreds of happy clients. So come on over to our website if you got time and you're kicking around, listening to us at work or over on a long walk when you get back to your computer. Check us out. Go to Morris, Morris, invest.com. And there we have the resources we mentioned on today's podcast as well. Wholesaling, if you're interested in mentorship with Tom Kroll, just go to morrisinvest.com/wholesaling. or you can check out the Fund and Grow team at morrisinvest.com/funding. We've got it all right there. We'll be back with another episode again on Thursday, which is tomorrow. And we got some great episodes lined up for you next week as well. So thanks so much for dialing us up, downloading, and we will see you back here once again on the Investing in Real Estate podcast. Now go out there, take action, and become a real estate investor.